Good evening and welcome to the quarterly update on Reliance Industries results. As we look back at this quarter, while we have several records and many good things to talk about, I want to start by outlining the operating environment for this quarter. And the first thing I would say is that this was a quarter in which we saw some of the toughest operating conditions in our energy businesses as we look back over the last 6 to 8 quarters. Despite that, we have a very resilient performance, and we think that this is a vindication of our business model of integration and optionality. Our consumer businesses, in comparison, had another great quarter. We saw growth in both retail as well as our telecom digital services and established new records in terms of subscribers, footfalls, loyal customers, margins, and every other financial parameter. Let me then just talk for a few minutes on the big numbers. We had record consolidated revenue of nearly 1,73,000 crores, up 12% sequentially quarter on quarter. Net profit just over 10,000 crores, flat quarter on quarter sequentially, and consolidated segment EBITDA just above 22,000 crores, up 2% quarter on quarter. Our consumer businesses now account for 32% of consolidated EBITDA. This is up from roughly 26% in the previous quarter and next to nothing 3 years ago. When we look at the macro operating environment, oil prices exhibited a fair amount of volatility. We had a range between 62 to 75 as far as Brent was concerned. But more importantly, we saw crude markets stay tight throughout the quarter as geopolitical events around Venezuela and Iran, around production cuts by OPEC Plus, and the basic tightness in the heavy crude markets all challenged complex refiners. On a global macro basis also, we started seeing lower industrial activity. In many parts of the world, we saw PMIs going to below 50, and it's safe to say that we are seeing lower growth globally in the last quarter than we have seen in several quarters in the past. With that backdrop, the good news is that India was a relative island of stability. We saw stable exchange rates. We even saw decent demand growth as far as our petrochemical business is concerned. Polymers were up 6% and polyesters were up 7% in demand. As far as refined products were concerned, gasoline growth was 10%, very healthy, and diesel demand was up 2.1%. So we benefited from the relative stability in the Indian markets, both in terms of demand as well as in macroeconomic terms. When we look at the performance of our energy business, I think I again want to re-emphasize that we have a resilient operating model which allows us to deal with volatility by making the best use of integration and best use of the optionality that is available to us within the portfolio. In this quarter in particular, we benefited from refinery-linked polypropylene production, which showed better margins. We saw margins shift upstream from paraxylene to PTA in the polyester sector. We saw our cracker portfolio becoming more competitive as ethane prices were 29% lower quarter on quarter in the US. And we did a lot of proactive crude slate management during the quarter, reacting well to the challenging environment that we were seeing. Also in this quarter, refinery throughput was up 9.4%. As you might recall, we had taken a planned maintenance shutdown in the previous quarter. But petrochemical volumes were lower by 7.4% simply because we took again planned maintenance shutdowns in two of our plants. With all this, GRM gross refining margin was relatively flat at $8.1 per barrel, even though its premium over Singapore improved. And petrochemical margins improved, but EBITDA was lower than the previous quarter. As far as our consumer businesses were concerned, some of the records we set were in Jio, our subscribers now exceed 330 million subscribers. We added a gross of roughly 32 million subscribers and a net of about 25 million subscribers in this quarter. Our EBITDA is nearly 4,700 crores in Jio, which is up 49% year on year. And we have the highest ever EBITDA margin of 40% from that business. Retail continues to show hypergrowth. Our retail business grew faster than any other retail player in the country in an environment of widespread commentary of slowing down by FMCG producers. And in the same quarter, we expanded our footprint by adding more than 200 stores and are now present in 10,644 stores across the country. We also crossed two very important milestones, that of 100 million registered loyalty consumers with us and seeing 150 million footfalls in our stores in the last quarter. With that background, let me talk about the financial highlights for the quarter. Revenue, nearly 1,73,000 crores, up 12.2% sequentially quarter on quarter. And as I said earlier, it came on the back of higher throughput in refining, even though that was partially offset by the shutdown in petrochemicals, and of course by the higher revenues that we saw both in retail as well as in Jio. Our consumer businesses now account for 26% of gross revenue and 32% of our consolidated EBITDA, which for this quarter was just in excess of 22,000 crores. Our net profit was relatively flat at 10,104 crores and our net debt virtually unchanged at 1,56,000 crores. So the records in this quarter are on the revenue front, quarterly consolidated revenue, and in terms of quarterly consolidated net profit. We have always also had the highest ever contribution from retail and Jio. Let's look at the financial numbers now for our petrochemical business. Revenue was down 11.3%, and as I said, that was primarily because of the shutdowns that we took. EBITDA was down only 5.9%, while revenue was down 11.3%. The factors driving the EBITDA were essentially softer paraxylene and MEG markets, which were offset to some extent by stronger PTA and polypropylene markets. EBITDA margin, on the other hand, improved 130 basis points from 22.1 to 23.4%. Primarily as we benefited from lower energy costs, feedstock flexibility we've talked about before. So throughput was down 7.4% to 8.7 million tons. In terms of our major products, polyethylene margins were softer, primarily because of inventories in the US and product flow from North America to Europe and Asia. Polypropylene, on the other hand, saw better margins, up nearly 28% in margin terms, simply because of tight supplies in Northeast Asia and refinery outages. Paraxylene was much softer, 35% lower in terms of margins because of a large startup in China. PTA, on the other hand, compensated for the fall in paraxylene with spreads that were 47% wider and among the best that we have seen in the last 5 years. The integrated polyester margin was above 5 years, but a little bit softer than compared to the previous quarter. So as we look at what happened in the previous quarter, clearly the softness in paraxylene and MEG was weighing on the petrochemical markets, but we compensated that to some extent by the polyester chain, particularly PTA, and to some extent lower energy costs. Our own outlook for the near term is constructive. We think that paraxylene markets are pretty close to the bottom, and even though there is overhang of new capacity, this will settle down over the next 2 or 3 quarters. We think the whole olefin chains is also in good this thing. We are seeing strong demand, and the inventories in the US will run down over a period of time. And we think that the integrated polyester margins will continue to be stable or improve as the end polyester demand continues to be robust. Let's now look at the refining numbers. Revenue exceeds 1 lakh crores, 1,721 crores, up 15.8% compared to previous quarter, up because of 9.4% higher throughput and 9% higher on average oil price. EBITDA at 5,152 crores, up 3.8%. As I said, GRM was virtually flat, and so is EBITDA. In terms of the various products, we continued to see softness in naphtha. Markets continued to be well supplied, and petrochemical margins, as we said, were a little bit softer, putting pressure on naphtha. Gasoline was a surprise. It came back from the lows that we saw in the last 2 quarters, actually came back quite strongly. And gasoline margins in this quarter were $7.5 per barrel compared to 3.7 in the previous quarter, well over double. Diesel stayed roughly flat, a touch softer. Aviation fuel also flat, just a touch softer. And fuel oil, which is important for a complex refining, was actually weaker, helping in margins. So all in all, while we saw a lot of volatility both in product margins and crude prices, we were able to get the best out of our refining assets by getting back to full throughput, using the flexibility that is inherent in the system, and by managing crude purchases proactively. As we look ahead, the good news is that this quarter has started strongly. Singapore GRM is at now $7.50 per barrel, nearly a 1-year high. We are continuing to see strong recovery in gasoline as the driving season in the US picks up and the inventories keep running down. The big event, of course, for complex refiners will be as we come closer to the end of the year and we see the positive impact of IMO, where we expect diesel margins to spike up and fuel oil to become softer, both of which are positive tailwinds to the refining business. A quick summary of our upstream business. Both revenues and EBITDA were flat as compared to the previous quarter. Production slightly lower, both in domestic as well as our US operations. The big development of our cluster field is progressing well. It's being monitored very closely, and it looks like we may have production from this new development at some time in 2020. So that's something that is the big news ahead as far as our E&P business is concerned. Talking about retail, as I said earlier, record quarter in many ways. Revenue, a new record at 38,200 crores, almost up 4% quarter on quarter. EBITDA crosses 2,000 crores for the first time. EBITDA margin improvement from 5.9 to 6 on a consolidated basis. But very importantly, when we look at core retail, which basically excludes petro retailing and connectivity, we had the best margin we have ever seen at 8.9%. And while we were growing all across all the formats, we were also busy opening stores. We added 229 stores in this quarter and continued to improve our penetration of Tier 3 and Tier 4 cities. With this, we cover most of urban and rural India and have a presence in 6,700 cities and towns. We now have retail area of over 23 million square feet. We have over 10 million square feet of warehousing space, and we are seeing growth across all consumption baskets. And the reason why we are successful in growing retail in the way that we are, which is the hyper growth and improving margin achievements, is basically because we are offering more to consumers. We are offering a better geographic spread. We are present in every part of the country. We are deepening roots in the smaller towns. We are offering better assortments. We are offering customers wider choices, and we are offering them better after-sales service and support where it matters. We are also beginning to take the benefit of scale in terms of promotions, product launches, and so on. So as we grow bigger and bigger, not only are we able to offer more to our consumers in terms of products and the assortments, we are also able to give them better deals simply because we are able to get better merchandising because of our scale and size. Let me now talk about Jio to conclude this update. Another great quarter as far as Jio is concerned. Subscribers went up from 307 to 331. ARPU went down from 126 to 122. But there is good news even as we look at ARPU. From our customer profile, we are seeing a distinct shift to the higher tariff packages, which are inherently slightly cheaper than the lower tariff packages. We continue to see the popularity of Jio phones and more consumers adopting that and coming first-time users. With that, gross revenue at 13,762, up 5.4% quarter-on-quarter sequentially. EBITDA nearly 4,700 crores at 4,686, up 8.2% quarter-on-quarter. And very importantly, EBITDA margin at 40.1% is up 110 basis points. We achieved another big landmark in this quarter. 10.9 billion gigabytes of data went through our network. So our consumers continued to have the high level of engagement, and we established a new global benchmark in being a 10 exabyte network. The voice traffic was up nearly 9% quarter on quarter at an aggregate of 786 billion minutes. The voice usage per consumer was flat at 823 minutes, and data consumption continued to go up and was 11.4 GB per month for each subscriber. With all this, we also continued the march on to leadership. In terms of AGR market share, we are now number one in 16 out of 22 circles. That should tell us that in most of India, 16 out of 22, we are the clear leader in terms of revenue. We also have, with that, the best network quality, no matter which way we measure it, and the lowest churn in the industry. We continue to invest to improve coverage and capacity and are now very close to our target of 99% of coverage. We continue to be the preferred service provider for a dominant number of consumers in India, as can be seen by the level of customer engagement, both in terms of data and voice. And at Reliance, we are very confident that the Jio and our retail businesses will go from strength quarter by quarter in the near future. Thank you.